Thanks for joining us at XM.com. This is a special report video. I'm Cristina Marujas, and joining me today is Cristina Barcenido, investment analyst, and we'll be discussing the Fed's latest expansion of swap lines. Now, besides cutting interest rates and expanding its QE program as an emergency move to fight the virus impact, the Fed also increased dollar supply outside the U.S. borders by broadening its swap line operations with 14 central banks last week. That's including the ECB and the Bank of Japan. This plan was also used extensively during the 2008 financial crisis. So what was the trigger behind this decision?
That's right, Christina. The Fed, in a coordinated move, increased the frequency and the maturity of its swap line operations, at least through the end of April, and reduced rates to several key central banks. And all that because markets abroad have already started to face dollar shortages. Unlike the financial crisis in 2008, we have a totally different threat now, coming from the deadly coronavirus, which put the global economy in a lockdown. And even if it's considered a temporary one, it could still trigger a recession. Another reason why the dollar supply outside the US is shrinking is because global trade activities and a significant portion of global debt is paid in US dollars. So traders are rushing to buy the currency in order to keep playing in international markets, something that declining cross-currency basis swaps and the steep rally in the dollar revealed recently. Besides that, the US is still relatively stronger than other economies such as the Eurozone and Japan, so traders feel safer holding more dollars than their own currency, consequently pressuring dollar reserves in foreign central banks, and that makes the Fed's support valuable at the moment.
Well, speaking of the dollar, as you said, probably the excess demand is responsible for the rocky rally the currency had last week. Do you think the Fed swap lines could calm nervous investors?
Well, it's definitely providing some relief to foreign central banks at the moment, but the effect on the markets could be temporary or marginal if the virus damage stretches into the second or even the third quarter. Moreover, there are some other considerations we need to take into account. One of them is the fact that emerging economies such as China and India are not involved in the plan. These economies have a massive amount of US assets, particularly US treasuries, which they could liquidize to meet dollar demand. Secondly, whether the Fed's extra dollar supply will eventually fully flow to the ones in need will depend on the foreign banks, multinational banks, which will probably get the Fed support, have stricter requirements and credit analysis for funding businesses in order to limit risks in the banking sector. So some help may be needed from governments to motivate those banks to relax their terms and accept more applications. Regarding the move in the dollar now, from a technical perspective, it seems it has reached overbought levels against 6 major currencies, and that suggests some downside correction in the short term, which seems to be currently in progress. However, another rally is still a likely scenario, especially if the Fed proves unable to remove the excess demand.
Christina, thank you so much for joining me today. And thank you for watching this special report video here at XM.com.